Hi, they call August silly season in the UK because the UK press kind of goes nuts trying to make up stories when there's not a lot happening, for example, politically. Although, of course, this year it's a bit different, notwithstanding Boris Johnson being on vacation. We are in a leadership battle over there. But silly season it is, and so what we've got is, the big meme stocks are making the big moves this morning. There's the usual massive counter-currents in the market, the biggest two today being more issues with Russian gas supply to Europe, hammering the European market basically, and the news that China is going through another easing process to try and regain some sort of control in their property market, which is an absolute disaster area. In fact, I read yesterday that the Chinese property market is twice the size of the US market, which I guess given Chinese population is 4 times the size makes sense. Anyway, one of the interesting things about these cross currents is there's some unusual reverse correlations. So for example, recently, past several weeks, we've seen oil in inverse correlation to European natural gas. And when you think about that, it's likely because the higher European gas goes, the more the risk of a major global recession, which would be bearish oil. These are tough markets. So yeah, there's that sort of inverse correlation difficulty. Now, I'm trying to be bullish oil. I'm actually long in the model portfolio, hoping that kind of against expectations, certainly of many of the clients and the technical analysts, we don't have a visit to the 80s here, but I can't say I'm super confident that won't be the case. I'm just kind of hoping, Athena, I'm just kind of hoping that we can rally here. The other big story of the weekend obviously was Oxy, which may be the end of the story in many ways, with the Wall Street Journal saying that Oxy doesn't want to be taken over completely and has asked not to be. And that stacks up to me actually, because I remember Phillips 66 management, when I knew them pretty well, had a similar message for Buffett that they'd like to retain the identity of the company and not be a full subsidiary of Berkshire Hathaway. So I could see, why would Warren want to pay another 60 billion, for more of what he's already got, when the price he's in at 50 to 60 is going to have to be more like 80 to take the thing out. I think what it does do, though, obviously, is firstly, it lowers the cost of capital for Oxy dramatically, because you have such a structural long-term shareholder. And obviously part of that is the fact that if there is any significant weakness, for example, a massive global recession followed by an enormous downside in oil prices, Oxy is super defensive, and we put it to a client, it might actually just have turned into an Aramco lookalike, a place where you hide in disastrous equity markets in the knowledge that it's not going to drop a whole lot. CLR, another Continental, another play that's converting to private more or less, would be a similar very defensive play. So that's about it. I'm around all week. I'm happy to chat, and have a great week.